Imagine it's a quiet evening and you're scrolling through your tax return from last year, the one with your beach house listed on Airbnb. You've been claiming the interest, the rates, the depreciation, and it all felt completely normal. Here's what you need to know. From the 1st of July 2026, the ATO has much stricter rules. If your property is mainly for your own holidays rather than genuinely earning income, it can be classed as a leisure facility. And when that happens, your deductions don't get trimmed. They vanish entirely. No part claim, nothing. Let me walk you through exactly what changed and what you can do about it right now. So here's what actually changed. The ATO has now spelled out that a property used mainly for your own holidays can be reclassified as a leisure facility under Section 26-50 of the Tax Act, rather than a genuine rental. And if you've been relying on simply having the place listed on Airbnb or stays, that's no longer enough. It's not because you've done anything wrong. Most people were never told this distinction even mattered. But if your private use and lifestyle pattern dominate how the property is really used, the tax treatment flips and it stops being treated as an income-producing asset in the eyes of the law. Here's why this matters so much for you. Before these rules, even a lifestyle-heavy property could claim its costs apportioned for the weeks it earned income. You got a fair slice. Now, if your place falls into the leisure facility bucket, there's no apportionment at all. Your interest, council and water rates, land tax, body corporate insurance, repairs and depreciation are denied in full, even for the weeks you rented it out at full market rate. The only things you can still claim are direct rental expenses, advertising, platform commissions and cleaning for guest stays. Everything else is off the table. And here's the number that actually shows you what that means in dollars, coming up next. Let me run the numbers three ways so you can find yourself in them. If you're at the smaller end, say a $400,000 unit, your holding costs at risk might be around $30,000 a year. In the middle, a typical coastal home worth $900,000 on a 6% interest-only loan carries $54,000 in interest alone, and once you add rates, insurance, strata, maintenance and depreciation, you're looking at $69,000 at risk. And if you've got a premium property closer to $1.5 million, that figure climbs well past $100,000. On that middle example, at a 37% marginal rate, losing the deduction costs you about $23,600 more tax every single year. And the ATO has real motive here. It reckons rental owners overclaimed $1.7 billion in a single year. Here's the sharpest number to hold on to. If you own a $900,000 Airbnb on 6% interest and it's treated as mainly a private holiday home, you could lose more than $27,000 in tax deductions every year. That's real money out of your pocket. Every single year you stay on the wrong side of these rules. But here's the part most people miss, and it changes how careful you need to be. Now I want to be upfront with you about the catch, because it's the bit that catches most owners out. The ATO has built a risk framework called PCG 2026-3 that sorts holiday homes into low, medium, and high risk. The red flags are things you might be doing without realizing. Blocking out school holidays and peak seasons for yourself, setting prices so high the place barely books, and reporting a loss year after year. And here's the kicker, the platforms now report your income, your dates and your pricing straight to the ATO under the sharing economy reporting regime, so they can cross-check what you claimed against your actual booking calendar automatically. The good news? Once you know the red flags, they're surprisingly easy to fix. So here's exactly what to do. 3 moves you can start this weekend. First, log into MyGov and download your last 2 to 4 years of tax returns. Then compare your usage against the low and high risk examples in the new guidance. This tells you straight away which side of the line you're on. Second, reset your calendar. Open up school holidays and peak periods for genuine bookings, and price at market rates using your platform's own pricing tools. Third, build your evidence. Create a simple log marking every day of the year as either rented, available, but vacant, or private use. That record is exactly what the ATO will ask for. Get this done before the 1st of July, and you put yourself firmly in the safe zone. Mark this date in your calendar. The 1st of July 2026 is when the new rules start to bite. But here's something to be honest with you about. Don't relax just because the past feels settled. The ATO can review the preceding 4 income years, and up to 12 if it believes there was avoidance. So the clock is already running on your history, which is exactly why the next step matters so much. Here's what's at stake if you leave this alone. And it's bigger than just losing deductions going forward. If the ATO reclassifies your property, it can reassess up to 4 past years, add a general interest charge running around 11 to 12% a year and compounding daily, and apply penalties from 25% up to 75% for intentional disregard. In our worked example, 4 years of underpaid tax plus interest and a modest penalty tips over $120,000, all due at once, long after the so-called savings were spent. The good news is that everything we've covered today puts you ahead of that, as long as you act before the rules land. If you've made it this far, you now know something most holiday homeowners don't: how to keep your property on the right side of the line and protect tens of thousands in deductions. Your one step today is simple. Log into MyGov, download your last few returns, and check them against the new guidance. It takes about 20 minutes. The final ruling and risk framework will keep firming up over the coming months, and that's exactly what we cover next. So you're never caught out by a 6-figure surprise. Just remember, this video contains general financial information only and is not tax advice. Your situation is unique, so always check with a registered tax agent or the ATO before lodging. I'm Sophie. I'll see you in the next one.